In this masterclass, I'm going to teach you everything that you need to know about one of the best concepts in trading, supply, and demand. We are going to go through all of this, and by the end of the video, you will fully understand the theory of supply and demand and how to apply it to find great trades. So with that said, let's get into the video. To briefly explain the theory of supply and demand, this is the thing that drives all markets. So we're looking at a price scale here, and when demand increases, so this will be our demand line, we see an increase in the price of an asset. So let's peg this to gold for this example. As demand for gold increases, the price of gold also increases. This happens because the supply of gold that's available ready to trade in the market declines with the increase in demand. Now, why does this happen? Why does supply fall as demand rises? Well, it's because, of course, if there are lots of people trying to buy an asset, i.e. there is lots of demand, then there are going to be people buying that asset, taking available supply off of the market. So that means as demand increases, more assets are bought up and the supply will decrease. A lower supply creates higher scarcity. 114 and a higher scarcity demands higher prices because, of course, if something is rare versus something that's not rare, the price is going to be more expensive for the rare item, okay? That is simply how it works. It's a very simple format if we then saw. Demand start to slow down, so we saw the market coming back down in terms of demand. This would mean people are selling their assets. Now, if they're selling their assets, the supply is going to increase. Okay. And as supply increases, of course, there are more readily available units in the market, which generally means if there is less scarcity, the price is therefore going to decrease. So as we see an increase in demand, we see supply lowering because the assets are being bought up. When we see demand decrease, we see more assets being sold to the market. Therefore, a lower price comes in due to the fact that there is now more available supply, less scarcity, and simply the fact that if demand's low, pretty much means no one wants the asset. To bring supply and demand into our actual trading and our technical analysis, we do this using zones. So this here. And this here indicates supply and demand zones. A demand zone is an area in the market before a large upward move. So when we see a sideways bit of price action, can be an individual candle, show you some examples in a moment, and then a large push away. This creates a demand zone. When we see the same, that kind of sideways price action of one candle, or maybe more before a large move down, this creates a supply zone. Now to talk about the theory as to why this happens. Basically, the reason that we use this as our demand zone or our supply zone is because it's showing us where buying and selling pressure came into the market. Now, in order for the market to slow down, kind of recoil and consolidate before a large push up, that tells us that this region here, where it slowed down, where it went sideways, is where massive buying orders have been placed. That is why the market drove higher, because demand kicked in here, supply was bought up. The price appreciates because of that increase in demand and decrease in supply. In the supply example, here we see the area of consolidation before a large move down as essentially a point where new supply has entered the market. Demand has declined. More assets have been sold readily available to trade. Therefore, with more supply and lower demand, the price depreciates. Now, the way that we actually trade these then is to buy demand zones when the market returns to them, or to sell supply zones when the market returns to them as well. So in the case of a demand zone, knowing that this area here is an area where significant buying has taken place, we know that this is what we could call a discount price. Traders before saw this as a very good price to buy this asset, so they stepped in masse, and we saw that large drive of momentum. If we then get up to this point and we start to slow down, this is telling us that the price up here is no longer seen as a discount price to buy, and it's no longer seen as a good price to purchase this asset. However, we have solid confirmation that this area here was indeed seen as a good place to buy from, a good price level to purchase this asset. So the theory is, and the concept is, if the market is to return to this price range again, we are likely to see a second phase of buying coming in because this is a discount price region. If it was a good price to buy before and now the market's appreciated, you can be damn sure it's going to be seen by a lot of people as a good price to buy it again. The same goes for supply, except this is what we would call a premium price level, okay? So if we take a look at this one here and we take a look at this one here, these are indecision candles. They are indicated as indecision by the fact they have large wicks and very small candle bodies. Wicks show rejected prices. So what we're seeing here with these wicks is attempts to go higher, attempts to go lower. And what we see with a small candle body is pretty much failure to get far in one direction either way. Okay, we didn't get high, we didn't get low in this given period of price action. So this creates an indecision candle. Now we are looking for the last indecision candle before an impulsive move. An impulsive move is a strong bearish or bullish candle or a series of strong bearish and bullish candles. So you can see the candle I've just marked here. This is an impulsive candle. It's a large sell candle with no resistance from the buyers we see as well. This one after this indecision candle is a large selling candle with clear strength from sellers, okay? No resistance from buyers. So that is how we're going to be plotting these in real time. We want to see the last indecision candle before the impulse. Last candle before the impulse is the rule I use. Now, if you've learned supply and demand anywhere else before, you might have the last down candle before the up move, the last up candle before the down move as a rule. I don't use that. I use the last candle before the impulse. The reason I do this is because it is this candle here where the selling pressure has accumulated. Okay, it's not the last up candle where the selling pressure came in. This was a strong bullish candle. It's here. It's the very last candle before the impulsive move. It's exactly where the momentum has built up to create a selling move. It's the selling pressure. So that is the rule. Last candle before the impulse is going to be the one that we use for our supply zones. Okay, so now to show you this example, we're going to focus in on this one. We're going to talk a bit more about differentiating zones a bit later. But for now, we've got our supply zone to mark a supply zone. We find that last candle before the impulse, and we want to mark the high to the low that includes the wicks. So our supply zone would be this. Okay, we've just gone high to low of this candle. What we would then expect is for the market to return to this level and then sell off from there, because we know that that's where the selling pressure has been previously. We know this is a premium price to sell from. So we would expect that to take place once again. And this is going to be a supply zone. So we're going to mark it SC. Why is it supply? Because it's in a downtrend. It's a selling move. Okay, demand is obviously when we pull back to a buying zone, supply is when we pull back to a selling zone. So this is a supply zone. So what we could generally expect to see from here, then having plotted that correctly, would be the market to return to. Here we would look to sell there, and then we would profit from a new low being formed as the market falls. So just as a very simple example trade, we would have our entry there, stop above the zone, and our target down at the low. We're going to get more into all of this stuff soon, but first brief example, here it is. So there we go, we see the market push into the supply zone, and what actually happens here when the supply zone is hit is a new wave of selling pressure comes in because of that discount price level, because that premium price has been hit. Sellers that sold here before are more than happy to sell here again, and you get this nice positive movement straight down to your target, which is of course how we make profits from supply and demand. Now, one very important thing about supply and demand is that you use it in line with the overall trend direction. So we can see this market is falling. It's creating lower lows and lower highs, meaning every low is lower than the previous one and every high is lower than the previous one as well. So what this tells us is that the market is in what we call a downtrend, okay? And in a downtrend, we only want to focus on selling supply zones. We do not want to buy demand zones. If we take a look at this market, we have multiple areas we could see potentially as demand zones, but if we were to buy these every time the market came into them, we would be destroyed. All of these areas would classify as demand zones. But if you were buying here on the way down, you're buying here, you're buying here, you're going to get killed. The kind of sneaky thing about supply and demand is that supply and demand zones visibly appear everywhere, but you need to trade them in context. So in a market that is moving down, we only want to sell from supply zones. We do not want to focus on demand zones. Now I'm going to give you a very quick class on market structure to explain it. Let's go. So through this phase of price action just here, we can see the market is creating higher highs and higher lows. Okay, so a higher high very simply is just a high like this that's been printed in the market that's higher than the previous one. Higher lows again, it's just a low that's higher than the previous one. So as the market is creating higher highs and higher lows, that puts it in an uptrend. And that means the only thing we should focus on doing here is buying demand zones. We should not sell supply through here. So this is an uptrend. We want to buy demand. And that is how we trade when the market is forming higher highs and higher lows. At this point, we see the market shift and it actually breaks into what we call a lower low. How do we get this? Well, simply this low is lower than the previous one, therefore it's a lower low, and through any phase of price action where we can clearly define the market as creating lower lows as well as lower highs, we want to be selling supply. So if the lows start to form lower than the previous ones, and if the highs start to form lower than the previous ones, this puts us into a downtrend. And during a downtrend, we want to pretty much ignore demand zones. And in here, we want to sell supply. Now there will be a card in the top corner of this video. If you really want further depth on market structure, lucky for you, I have a full masterclass on that as well. Click in the top right somewhere and that will take you to it. So here we have a market that is creating lower lows and lower highs. Therefore, what would we want to do? We would want to sell from supply zones. Now an extra little lesson woven in here, I'm going to use this sideways candle, this pullback candle, this kind of indecision candle and this downward move as supply, as we can see in this example. There is a little wick here that extends further on the next candle, so I would actually use this candle to mark my range, the blue one, but I will extend the high of the zone to the wick. That's been created by the next following candle. Okay, so we use the high there down to the low here that creates our supply zone. So the idea is then we are going to sell supply because the market is currently downtrending, creating new lows and new lower highs consistently. So that would be pretty much where we get into a trade from that point onwards. And as we see the market coming down, of course, we could then just continue selling supply zone. So we see again, indecision candle, the market pulls back to supply. That would be another opportunity to sell. Okay, so that's the general idea as to how we focus on a downtrending phase of price action. Now, as we can see coming in from this point, we are starting to push to the upside. Taking a look at the structure, we actually pushed over this high. So we have a high, lower, low, lower, high, lower, low, lower, high, lower, low, lower, high, lower, low. The market's pushed up and now it's created a higher high. So this actually puts us into an uptrend. Okay, meaning what? Do we want to do an uptrend? We want to buy from demand. So here's our indecision candle, our sideways candle before the impulse. Last candle before the impulse is what I use for my zones. And what we want to do at this point is buy from demand, meaning any supply zones that form will be ignored. Okay, you can see that demand zones did form in this move up, but we ignored them and focused on selling supply because the market direction was down. Now that we've shifted up, we want to focus on buying demand, and we want to ignore supply because the market direction is up, and we are moving with the market direction using supply and demand to make our executions. So in one moment, you will see market returns towards this area of demand, and then we get a tap in and a push away into new highs. So that is how we use supply and demand in line with the trend, with a real example there of a downtrend selling supply and an uptrend by buying demand. So in order to validate a supply or demand zone, we need to make sure there is something we call an imbalance. If there is no imbalance into a zone, then it's not a zone that we want to look at. If we take a look at where I'm drawing these black lines, we can see just above this candle here, this blue candle is going to be our supply zone. Okay, it's the last candle before this impulse to the downside. Now we can see what we have beneath the low of that candle and then above where price currently is. There is an imbalance, right? An imbalance is an open price range. It's this area here. Basically what it is an area that hasn't been filled yet with wicks. If this candle had pushed up and hit that area, then this would have created what we call efficiency and removed any imbalance into that zone. But because we still have this open price range here, that means that there is imbalance into this supply zone. So this would be a good supply zone to sell from. Okay, and we would expect when the market comes back to it, we could happily sell from this point because that would fill the imbalance, and then the market would be likely to move lower. Now you have to have an imbalance to your supply or demand zone. Otherwise, it's not really valid. So if we take a look above, we've got here this indecision candle. This is the last candle before an impulse to the downside. And just to clean it up, let's get rid of this. We'll get rid of this. But the problem with this zone is there is no imbalance into it anymore, right? So here we have our supply zone. We have a push away. The markets pulled back, filled in balance, and pushed down. So initially, if you were looking at this supply and you wanted to sell it here, that would have been okay. But now that this has already been filled, now that there is no imbalance, this would not be a good supply zone to try and sell the market from. For two reasons. Number one, the market probably isn't going to get there because it's probably going to react from the area with the imbalance. Number two, if it does get there because the imbalance has already been filled, there's a high likelihood of actually pushing higher, which means it's low probability and probably isn't going to give you a good trade. So we need to trade from supply or demand zones that still have imbalances, okay? If we look in this leg of price movement, there is no imbalance up here. There's no open price ranges. Every wick is touching previous wicks, right? So we have this wick pushed up, touch this wick. We pull back down. We have these wicks being filled by these wicks. But then we have a push down and we have a gap here where the wick is not meeting the wick. So that is basically going to create our imbalance, making this the high probability point to sell from. And to show you that in action, that's the kind of movement we would expect a fill of the imbalance and a push to the downside, and a rule that goes alongside that is, of course, that a zone is only really good on its first tap in. Okay, so here we, of course, had the first tap in of this point. So we created supply, pushed down, pulled back, and then sold off. However, if the market was to come back into this supply zone again, we wouldn't want to trust that for a trade because it's already been hit. And basically what we're looking for is for the supply zone to absorb all of the new sell orders and drive lower, like the one we're currently looking at. We have supply, the market has pulled back, filled in balance. As soon as we hit supply, we absorb all the selling orders, new sell orders that come into the market. We go and make a new low, which means this supply zone is pretty much redundant now. The actions we would then want to take would be to start looking at, the next imbalanced supply zones. For example, maybe like this one. But if the market was to return to that supply zone again, so if we came up to here, we definitely wouldn't want to look for another sell, okay? The more times a supply zone is hit, even if it doesn't break the first time, the more likely it is that soon it's going to break through and actually go the other way. So let's take a look what happens next. Not 100% sure on this one, but we can definitely take a look at that. We can see that if the market comes up to this level, we don't want to sell there again because there is a high likelihood, as you can see there, that the market's going to go through it. So although we had this supply zone prepped up, we had the first trade, which would have been a great trade. But then the second tap, we don't want to sell here. This is not likely to get us into new lows. As you can see, it didn't do that. Third tap, we don't want to sell there. Fourth tap, we don't want to sell there. And then on the fifth tap, it actually breaks through. So a supply zone is only really good for its first retest, right? After that, ignore it. And the same goes for demand. If we're in a buying example, of course, we only want to use the first tap of a demand zone. Then we move on to other zones to validate next trades because the more times that demand zone is remet, it's essentially showing us that the buying pressure is not strong in here anymore. And it's showing us sellers are really attempting to push this lower and eventually they will likely win. So crucial tips to remember when trading supply and demand: always trade it in line with the trend. Only trade in balanced zones. So any zones that aren't imbalanced are not worth trading, and only trade the first tap of a zone. If a zone has been hit 3, 4, 5 times, do not trade it. It will likely break. Okay, now that we've covered all that, I want to talk about different zones. So we're going to talk about extreme zones first of all, and then how to approach multiple zones. So this market is downtrending. Okay, we had a break of structure here. The market has created a new lower low at this price point. Say we want to sell this. How are we going to select which zone to sell from? First, we can follow the rule of imbalance. We say we want to see imbalances into a supply zone. Otherwise, there is no reason to take a trade from that point. If we take a look anywhere, pretty much from the top of the movement down to here, we can see there is no remaining imbalanced zones inside of this price move, so every single one of these zones here has been retested by a wick. There is no candle where the wicks to wicks are not meeting each other. Therefore, there is no imbalance. Okay, now there was some slight imbalance created here, but we see that the market filled that range and retested just here, so all imbalance before this point is filled. There is no imbalance ahead of this level that's going to lead us to look at this area just here. And in here, there are two areas that we could look at as our trade entry to sell. The first is this one at the top, this indecision candle before this impulsive move down. This is what we call the extreme zone. Now, an extreme zone is simply the furthest zone from price in the existing leg of movement. So if there was an imbalanced zone up here being within this leg of movement from the top down to the bottom, the extreme zone would be whichever the furthest one from where price currently is up here. However, there isn't any imbalanced areas up here. So the furthest zone from price inside of this existing leg of price action from this point right now is going to be this one that we've drawn the red arrow to, because this is the final imbalance zone. Therefore, basically, if the market gets past this, we can expect, because there's no real supply anywhere in here, that the market has a pretty good likelihood of actually just moving into new highs. Okay, so if we're looking for the highest probability place to sell from, we can do that from just here. Now there is of course a level.